Hi everyone. In a past video, we talked about why you would want to trade using algorithms instead of trading manually. What are the advantages of using algorithms? And at this point in time, you may be convinced that this is the right way of making the trading, and then you might ask yourself the question on how you would go about sort of setting up a computer algorithm to do algorithmic trading. And I won't talk about the sort of the coding part, in which I talk about in many of my previous videos, but I'm going to talk today about the various elements that you would need to set up in order to build a profitable algorithmic trading strategy that can actually go and trade in the markets for you instead of you spending your time trying to do your trading. So let's get to it. So now let's come to the elements of algorithmic trading. So what is the first thing you want to do if you want to do algorithmic trading? You want to specify the entry. What's the entry? It is the point where you decide to enter a trade. So let's say you are sitting in front of a chart like this, where you have, Bitcoin versus USD, 5-minute chart, and then your algorithmic trading strategy has to decide when to enter a trade. Is this the point you want to enter a trade? Is that the point you want to enter a trade? And so on and so forth. So how do you make that decision? You make that decision based on some technical indicators. So if I had to break down these indicators, there are various kinds of technical indicators, and that is basically the recipe of your strategy. But remember that there are two important things you might want to consider. First is momentum. Some traders are relying on momentum. They are relying on the fact that if a stock is going up, it is going to go up for a while, and we are going to be able to sort of ride that wave. So if I'm here and I notice that the stock is going up, I'm going to be able to sort of ride the wave, and then at some point I just decide to take my profit and get out. That's a profitable trade. So if you were to enter a trade here and then you get out here, that would be a really profitable trade. So that is what momentum is. The second important thing is the opposite, which is mean reversion, or reversion to the mean. And that's sort of an important sort of statistical concept, which has deep statistical roots, but also makes sense from a common person's point of view, is that the stocks generally revert to their mean value. So the mean value here in this stock is probably something like this. And you can see that like the stock is sort of going up and then but tries to come back to its mean value. It's going down and it's trying to come back to its mean value. And you might want to sort of catch those reversal points. For example, you catch this point here, and then you might be able to sort of find that it reverses, the stock reverses here, and you can sort of find the point where it makes the reversion and then sort of use that to make your trade. So again, there are very complicated strategies which allow you to do that, but I'll cover two simplest ones. So if you are considering momentum, the simplest momentum strategy is to use double moving averages. So here I have plotted the 9-day moving average in orange and the 20-day moving average in blue. One possible way of making a trade is to look at the point where the fast moving average, in this case the 9-day moving average, is above the slow moving average, that is the 20-day moving average. So we could sort of start a trade here. So that would be an example of an entry point using a momentum strategy. So in this strategy, the simplest strategy is to use a fast and a slow moving average. And then there are many variants of that strategy. So for example, you can say, I want an exponential moving average instead of a simple moving average. You might say that I want the price to go above the moving average, and so on and so forth. but the idea is that you catch a momentum. Moving averages may not always work. None of these strategies always work. So for example, if you are trading sideways, you might, take a trade here where the fast moving average exceeds the slow moving average, but that trade might not yield you. Yeah, you might get stopped out here, but we might not reach your profit target depending on how high your profit target is. So that brings us to so that's the problem with the moving average strategy. It won't work always for you. That was the first strategy we learned. Let's take an example of the second one, which is reversion to the mean. The easiest way of doing that is what is called support resistance. And that's a strategy that I often think is one of the more useful strategies. A lot of traders use it with great success. But again, it comes down to a lot of nuances of the strategy. So as you can see, we have some support resistance lines based on what the stock did previously. So we were able to draw these lines based on how the stock performed previously. So as you can see, like there was a huge sort of line of resistance here, which became a support here. But later on, when we looked back at the stock, we see that this is where the mean reversion happens. And then it again happens at a bunch of places, like here, for example. You can see that it sort of goes to the support and it sort of bounces off of the support. Here again, it goes to the resistance, bounces off the resistance, goes to the resistance, bounces off the resistance. Just before, you can see it bounces off sort of the So that is support and resistance. So the way you make your trade is to basically believe that once you hit this level, the stock is going to change its direction. Once you hit this level, the stock is going to change its direction. And you place your entry points when the stock hits the support or the resistance. And that is one way to make your trade. So those are two important sort of entry strategies. And I feel like a lot of people in algorithmic trading spend all their time on entries. But that is not everything. Why is that not everything? It's because you don't have to, you need to think about the entry, but then you also need to think about the exit. Where do you exit a trade? And that is actually an even more important point. I think some of these strategies will actually yield you more than a 50% sort of chance of winning a trade if you use like some variation of this SMA or support resistance strategy with some nuances. But that is not the whole story. The question is, if you take a trade, how do you do risk management? So you need to find where your take profit point is and where your stop loss point is once you decide to trade. And that is really important. So for example, if you decide to take a trade here, you need to say, so here you need to say that this is I will take profit here. So I started the trade here, I'll take my profit here, and I'll take my stop loss here, or something like that, right? And you need to decide that ahead of time, because it's a computer. You need to say, if it hits this line, I'm going to take the stop. It's my stop loss. I'm going to sort of cut my losses. If it hits this one, I'm going to take my profit. And the important thing is, if you have so you want to make like you want to have like a ratio, like profit to stop ratio. So if you have a 60% winning strategy, win rate, and you have a 1:1 stop loss, that is a winning strategy. Why? Because because if you win more than 50% of the time, and because your stop loss is 1:1, you are going to make a profit in the long run. But if you have a 1:2 strategy, that is, you put your stop loss twice. So if you take profit here, let's say you start a trade here, and then you put your stop loss twice the distance away, in that case, even if you have a 60% win rate, you are actually going to lose money, because the 40% of the time you lose twice the money, right? So, but the 60% of the time you win 1x, and the 40% of the time you basically lose 2x. So it's not just important to have an entry point with a high win rate. It is also important to have a good risk management that takes into account how good your win rate is. Even a 50% win rate is good. If you, let's say you have, instead of doing this, you have a 50% win rate, but you have a 2:1 stop loss, profit to stop loss. That's a winning strategy for you. So those are the two important things when you want to decide how you want to take a trade using algorithmic trading. The next few things are about the setup of the algorithmic trading. And when you set up an algorithmic trading strategy, like, the other thing you want to remember is the offline backtest. So you want to use historical data and historical data from multiple instruments in multiple periods in time: bear market, bull market. You want to make sure that your strategy it works in all different market regimes. That is really important. And this is the advantage of algorithmic trading over manual trading strategies, because if you are trying to develop a strategy manually, as I was saying at the beginning of the video, you cannot test it for various market regimes, for multiple instruments. That would be a huge effort. But a computer can do this in a matter of seconds. But you want to make sure that your offline backtest is good. When you do your offline backtest, you want to look at the variance of the results. So you might get, you might run 100 tests, and I show this in some of my videos. Like, some of them might win, like 50 of them might win, and 50 of them might lose. You want to see what is the worst case, right? What is the worst case? Are you prepared to take that worst case? Because in the real world, you have 100 different scenarios that can happen, and you need to be prepared for the worst scenario. So you want to look at all the possible scenarios. You want to see if the worst case is really bad, and are you prepared for the worst case? Okay. So the final, the next thing you do is an online backtest. Sometimes your offline backtest and online backtest may not be the exact same thing, because the online backtest will verify that you are not using data from your future. I'll give you a great example here. So when I talked about using the SMA strategy, I said that you can take a trade here and you can, sell it somewhere here, and that would be a winning trade. The problem with that is that when you actually, we're looking at this after the fact has happened, but if you are actually trying to take this trade, remember that only when this candle finished, you knew that there is the fast moving average has crossed the slow moving average, which means that you are only going to be able to take the trade at the open of the next candle, which is actually a much higher value. That makes your trade much less attractive than it seemed when we took the trade here. So if you made that mistake in your offline backtest, you can be able to correct that mistake in your online backtest. then you can know that there is a reason why your offline backtest did not work. So that's the online backtest. And finally, you want to be able to execute your trades. So you want to be able to execute your strategy for 24 hours, 7 days, right? This is more of a question of your sort of computer knowledge and your ability to build together an infrastructure to be able to do it. You need to find the right brokerage, which allows you to sort of call APIs to execute trades in real time. That seems trivial, but some brokerages might not allow you to do. I think some are better than others. Some might have a complicated sort of language which is not supported, and so on. The other piece is that you need to have real-time price, that is information that is accurate. It might seem trivial, but if you are looking at 5-minute time intervals or 1-minute time intervals, often you will get, especially from the free sources, you might get information where the price is not accurate, and that will be a huge decisive factor on whether you have a winning strategy or a losing strategy. And ideally, you want to run it 24/7. You want to be able to use some kind of virtual server like AWS or DigitalOcean or some other server which allows you to run this whole thing 24/7 without interruption. And then that is sort of the more infra piece of the puzzle. So those are the main important steps if you are thinking of building an algorithmic trading strategy. You have to think about where the entry point of the trade is, when the exit point is. You have to build an offline backtest, and then you have to sort of know how to analyze statistically the results of that offline backtest. Then you have to build this online backtest and finally find the right infrastructure. So I hope you got a good overview of what it takes to build a good algorithmic trading strategy, and you can sort of build up from here and execute your own strategy. Thank you.